became fund manager. Amit, hi, very good having you. Let me first start off, Amit, with your perspective with regard to the underlying credit growth, 18% plus on a YOY basis for the month of June as well. One, do you believe it's sustainable? And second, do you believe that that can translate this year around to profitability or pretty much, mid to late teen kind of profitability do you expect even from the larger banks and across the board at the very minimum?
Thanks for the question. There are two parts to the question. One is linked to credit growth. We should see credit growth in line with what happened with the bond market after the war. So some part of the credit growth is the shifting of the bond market credit to the banks because the short-term yields spiked after the war. Some of that and that led to a reduction in the lending differential between banks, MCLR, and the underlying market in terms of bond market, and that led to shift of credit to the banks. And if you see the division or the subcontext of the credit growth, it is largely driven by corporate in the last quarter. So most of the banks which have reported have seen an acceleration in the corporate credit growth as compared to the retail credit growth. So 18% may be relatively a higher number. We think it should settle somewhere around mid-teens by the end of the year. On the second part of the question on profitability, banks' margins have seen some pressure, and that has largely to do with the balance sheet mix of banks, where asset side is largely linked to repo rate, while the liability side gets repriced with a lag. So we are seeing the asset side getting repriced earlier as compared to the liability side, which has led to some temporary margin pressure. We don't expect any further rate cuts from RBI. Actually, there may be a case for some rate hikes in the second half of the year, which is positive for banks' margin. So net-net, this credit growth should lead to, even when it is driven by retail credit, a margin pickup towards the second half of the year.
You spoke about wholesale lending, and which means that there seems to be probably a Capex cycle at play or just about starting, right, Amit? And this Capex cycle is also being funded by debt. So it's an opportunity across the board. It's fresh money coming in. It's not equity funds which are being invested. So there's also a reasonable amount of confidence, is the sense I'm getting. But talk to us about how do you play it?
So from the point of view of the funds that I manage, which is the UTI Value Fund and the Dividend Yield Fund and the ELSS Fund, largely how we are positioned is we are playing this upcycle in the macro environment through banks because we think that they are the, in terms of valuation, especially private banks are very comfortable. Growth is now above mid-teen. Profitability is at cyclical highs, and it has been at these high levels for the last few years on a consistent basis. Asset quality is under control, and the regulatory and the monetary policy environment is also favorable. On the pure play Capex side, because of the valuation concern or the valuation multiples that the capital goods sector is trading at, I am a bit cautious. But yeah, the point that there is a acceleration is in Capex, especially in some segments linked to renewable or energy, is correct.
Okay. And Amit, within that renewable space, within the energy space, would you play it through commodities, oil and gas and the like, coal, etc., or would you play it through some of the ancillaries to the to the renewable energy kind of setup companies? How would you play this theme? Would you play it through power producers? Would you play it through the ancillaries? How should one play this?
So when a company does a capex or the industry does capex, generally the people who supply various component or various sub parts of the capex are the largest beneficiaries. And we are seeing short cycle capex picking up. So, from an investor point of view, one should look at investing in the short cycle beneficiary of the supplier of this large capex, smaller companies who are supplying at various parts of that capex chain, rather than the companies who are actually doing capex, because most of the energy related capex would generate regulated returns, while the companies who supply various or linked to the supply chain of that capex have no regulatory ROEs or return ratios. They are subject to market and competition. And as you know, especially in the power supply chain, most of the capacities are full and booked. So most of the companies are earning, some of the companies are earning above normal margins. So they would be a larger beneficiary of this capex.
Okay. Amit, that's on the lenders. How do you look at IT? Because that's really the one which is the flavor of the month, or the month of July was the flavor of the month. How do you look at IT?
So we are positive on IT, especially given the valuation that we are sitting at. Many of the large cap IT plays are at 6 to 7% free cash flow yield, 5 to 7% dividend yield, and they are pricing in sub 5% growth. And if you look at the actual delivered numbers over the last 5 to 10 years, they have delivered on a rupee basis, even the large cap, anywhere between 5 to 10% CAGR on the top line side. Rupee depreciation is also positive for IT companies because it provides a cushion to the margins, especially in this deflationary environment. Now, the initial part of the AI cycle has been deflationary for most of the IT companies, and that is how the normal technology cycle are always like that. Initial part is deflationary, but the next part of the cycle where companies will try to figure out how to use AI in an enterprise environment will lead to a sharp increase in TAM, is what we believe, and which will create opportunities for agile IT companies. And that is what we have seen over the last 3 or 4 technology cycles. Uh, I agree that this cycle is significantly different from the previous cycle because of the deflationary impact. But we think that finally, as the TAM increases in terms of IT spend, and the IT spends move from hardware to more software, our IT services companies will also gain a pie of that spends.
Okay, so that will likely play out, but the deflationary effect on the top line will be visible. Amit, how quickly, if you have a view there?
So it's already visible for the last 1 or 2 years. You are already seeing the deal environment to be very robust. Most of the IT companies are having record deal value outcomes, but it is not getting translated into revenue growth. And the main reason is because of the back book, which is deflationary, which is taking away some part of the growth which should have come from new deal signings. So the significant part of deflationary pressure on AI is already reflected in the numbers that we are seeing over the last 4 to 5 quarters.
Amit, all the time we have, but was a good interaction. We understood IT better. We looked at banks and how they'll probably evolve in terms of earnings for FY27, and also the interesting piece with regard to the Capex cycle, which is underway, and renewables and energy. Thank you so much, Amit. Appreciate you coming in and speaking to us.
Thank you.